Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Man and I wanted to talk about the instant asset write-off, which is a policy that has been played around with over the last couple of years, particularly through the COVID period. Can get a bit confusing, and so we thought we would record an episode to kind of clarify it, and then also help people in business work out, what is their entitlements, and if this instant asset write-off policy or rule is removed, what are the particular outcomes? So the reason this was changed initially is that the government knows that business investment is a critical part of GDP and growing an economy. And what you really want in a growing economy is businesses reinvesting to build their productivity. And if they build their productivity, of course, that then results mostly in higher levels of employment and a healthier economy. And so what better way then to encourage business investment to give businesses tax deductions? And so what I thought we'd do is start off by talking about kind of what is the standard approach when we buy a depreciable asset. Or in fact, where we buy an asset and some of those are depreciated and some of them can be written off. So in the absence of these instant asset write-off rules, typically if you buy an asset that costs less than $300, you can just write it off. No problems. If the asset costs between $300 and $1,000, you can depreciate it, but you can put it into what's called a low value pool, asset pool, which means that you don't have to account for each individual asset on a depreciation schedule. You can just add it into the pool and then write off the value of that pool by 37.5% each year. So it's just a way of kind of streamlining things. If you go and buy, 50 assets for $900, you don't want to have a massive depreciation schedule. But if the asset is worth more than $1,000, the cost associated with it, then you have to depreciate that asset over its useful life. And of course, the useful life for accounting and tax might be different, but of course the ATO has a schedule of useful lives and depreciation rates for all different assets. And so they're going to be over that defined period. So that's kind of the standard, which means that if I'm going to make some business investment, probably going to cost me more than $1,000. Not many assets you can buy these days that cost less than $1,000. So if I'm going to invest in my business, chances are the only deduction I'm going to get for doing so is depreciation. And if they're significant assets, unless they're technology, the useful life's probably going to be 10 or more years, which means that I'm going to get a tax deduction, but it's going to take me a long time to really benefit from that. And that's why they brought in these instant asset write-off rules. And so maybe, Manny, you can take us through, what do they look like and how they've changed over the last few financial years.
Yeah, definitely. And it's a bit confusing because the thresholds have sort of changed over the last few years, especially through COVID. There was a bit of a grace period, but the current threshold is $20,000, and that threshold's actually been extended up until 30 June 2025 for small businesses. And there is always talk of further extensions, but at this point in time, it's up until 30 June 2025. Obviously, the government doesn't want to encourage too much spending at this point in time, given the inflation figures and so forth. So I think this space will be sort of tightly regulated over the next couple of years, but I think it's just watch this space at this point in time. For FY21, FY22 and FY23, so basically the COVID years, that was extended out to $150,000, and prior to that it was $1,000. So what's the eligibility criteria? So basically business size is one. Primarily for the current $20,000 threshold, the turnover needs to be less than $10 million. So unfortunately that will exclude a lot of businesses, and that's an aggregated turnover too. For the COVID years, when the $150,000 threshold was in place, that revenue target actually got increased to a $500 million turnover. So it was quite substantial during those financial years. The next eligibility criteria is the asset cost. So it must be below the threshold of $20,000 and it must be installed and ready for use within that time frame. So you can't, for example, buy an asset at 29 June 2025 and it's not ready for installation until, say, 10 July 2025. 2025, that won't be eligible. So it's important to actually watch the timing of these asset purchases so you don't fall short of the threshold exclusions.
Most assets are included, so plant and equipment and technology and these sorts of things are included in what you can write off. There are some exclusions, like capital work. So if you go and build a building or a structure, so a factory, for example, you're not going to be able to use the instant asset write-off rules, although, try and build a building for less than $20,000 is going to be a challenge in of itself. And the only other exception or limit was for cars, and this really relates to previous financial years, so 23, 22 and so forth, where the instant asset write-off limit was $150,000. In that situation, you could buy a car up to the luxury car limit and write off the full cost of the vehicle in that year. Of course, now that the threshold is $20,000, you can still write off a car, but of course you've got to buy something for less than $20,000, which again can be a challenge.
So other considerations that are in play here is that the asset must primarily be used for business purposes. So, no personal use assets included as part of this criteria. And you can claim multiple assets as long as they're all below the threshold and they're not related to each other. So for example, if you go buy, let's say, a computer and there's a whole bunch of add-ons to the computer that exceed $20,000, then it's sort of combined into one asset. Whereas if you buy multiple computers, and they're all under the $20,000 threshold, then you can depreciate the full each and every computer in its own right. Now, it's also important to keep accurate records of purchases and report it correctly in your financial reports. Now, going on a tangent here, but even for your smaller purchases under $300 or so forth, sometimes it's tempting just to put it into an office expense category or something similar. I always recommend clients to actually capitalize all assets and put it in a depreciation schedule so that when you come to borrow from the bank, they can actually add that back. Whereas if it's all lobbed in one sort of printing and stationery or office expenses or similar, it limits your borrowing capacity.
So the things to think about then for business is up until 30 June 2025, do you need to buy any assets, and are those assets less than $20,000? Because if you're contemplating doing that, so if you're not really sure if you want to make that investment, certainly one thing you want to take into account is the tax deductibility of that, and you're getting to write that off all in 1 year. That's pretty attractive, and of course it depends on your circumstances, but that would be one of the things that you want to take into account. Now, will it be extended beyond 30 June 25? Well, this policy's been in place since 2016. So it's been around for a while. And one of the things that the government's going to be really thinking about is if they do take it away, it does discourage business investment. And I'm not really sure, given the tight labour market and the low level of productivity that Australia's recording, that they really want to do that. So if I was a betting man, I would say that it's probably going to be extended. Although if you're going to make some substantial investments in your business, you probably want to make certain that you're going to get a tax deduction for it, if that's going to be a key consideration, in which case then you should do it now. So it's about sort of planning for your equipment, making sure that you know which types of equipment are categorized and are going to be able to write off. And as Mina points out, a great point around, I guess, maximizing depreciation and minimizing expenses, because that increases your borrowing capacity. Okay, that's it for us for this week. Until next week, bye for now.